Okay, so that dollar duration gap I showed you, that I'm not making this stuff up. This is exactly what I did. So I said, okay, the dollar duration is my asset duration times my duration of my assets, 15 billion. Liabilities times the duration. That gives me a dollar duration gap is 25.5 billion. I'm sitting there just waiting for it. Yeah, Ron, I got a 10-year duration. Okay, 10-year duration. I need a notional of 2.55 billion. Oh no, wait, here's one that's 30-year duration. Okay, 30-year duration. I need, yes, it could have been a 30-second phone call. You know, he just needed to know the notional I need. He already knew he knew I wanted to receive fixed and play floating because he knew I wanted something that was going to benefit if rates fell. So he already had that down. All he needed to know was the notional. So you notice the notional starts off at 0. A swap's market value is 0 when you enter the swap. It's priced to have a market value of 0. 3 seconds later, it's going to change as interest rates change. And it reprices as if I owned a 30-year duration bond. You notice, see how I have this on the asset side. Remember what we did on the banks? We put it on the liability side. But on pension plans, we think of it on the asset side. We're trying to manipulate not the duration of our liabilities, but manipulate the duration of our assets. All right. And my swap dealer, he sent me an email through Bloomberg, had my entire swap set up. Y'all should try this on Bloomberg. There's a really, really cool function in Bloomberg where you can actually set up a swap and do scenario analysis with it. It's really, really pretty cool thing. That's what he sent me. It's really unfortunate he sent me that because I was like glued to that every 2 seconds. When it jumped up 40 million, when it lost 40 million, there was one point it was over $500 million. I was like, wow, this is really cool. So, you know, it can move around quite a bit. So let's say interest rates fell 200 basis points. If interest rates fall 200 basis points, what's the assets going to do? Well, minus 0.02. I mean, minus, you know, remember this, minus duration times the change in yield, minus 0.02. Yeah, I did something wrong. So minus duration times the change in yield. Assets should have gone up 10%. Sure enough, assets went up 10%. What should the liabilities have done? Minus duration times minus 0.02. Liabilities should have gone up 30%. They should have gone to 35.10. Sure enough, they did. What's the swap going to do? Minus 30 times minus 0.02. That should have gone up 60%. It should have gone up 510 million. That's what it did. It went up, it had hit 516 at one point. I was like getting ecstatic about it. So what happened? The assets went up to 3.8 billion. The liabilities go up to 3.5 billion. What happened to my surplus? Nothing. What was my goal? Duration of net worth of what? 0. I want to be completely immune to interest rates changes. And this is our goal. All right. But we failed miserably. Let me show you how we failed, but we failed in a good way. So we're using the swap to hedge this. So this blue line is the discount rate for our liability. What happens to this pension liability right here? It's going to shoot up a bunch. What happens to pension liability right there? It's going to fall. So I'm using the swap curve as the hedge. So what's the swap doing here? It's up a bunch. It falls. How good is that relationship? You can see there's some problems, aren't there? Like right here, I'm going to win because the liability is hardly moving, but my swap's making a lot. But then I'll lose it all back here. This here to here looks like it's pretty well hedged, pretty perfect here. All right. Now what I'm about to show you is you should almost pass out. I should probably have to give you a warning. You know, be careful. Make sure you're sitting down because this is, I don't know if it's a 1 in a million year, 1 in a trillion year. I don't think it ever happened again. Y'all ready? Are everybody sitting down? I don't want any heart attacks. This is what happened in 2008. What did the liability do? It actually fell in value. What did our swap do? Went up in value. So our hedge fell apart, but what did we do? We made a fortune. All right. What did the people running this? Wasn't my responsibility anymore. I moved to a new job. My boss came in and said, I talked to them, Ron, and they said they don't need to do anything because we're hedged. And so I go, you're hedged, but your hedge fell apart. And he was, when I more talked to him, he slammed his fist on the table. I wasn't sure if he's mad at me or at them, but fortunately he was mad at them. But I was like, why don't you sell this and buy that? So I actually met with him on this day, right here. Sell the swap, it was up over $500 million, and go out there and buy triple B bonds that are at a huge discount. He said, well, you can't do that. It's an illiquid market. It's an illiquid market for sellers, but it's not an illiquid market for buyers. Anybody heard of Oak Tree Capital? They were buying bonds during this time and making a fortune off of them. I was like, no, you're a buyer in a buyer's market. I mean, what better could you want? Sell this thing for $500 million and go buy that for $500 million. And their argument, we don't need to do that because we're hedging. Are you really hedged here? Doesn't really make sense. Do you really expect these two things to move in parallel after this? Doesn't make sense, does it? So their answer was, let us think about it. So they finally did the trade somewhere around here. Somewhere around here. They threw away probably about 200 million bucks waiting. And it wasn't just I that was telling them. I had every fixed income person in the investment company say, sell the stupid swap and buy the corporates. So I was like, this isn't just me talking to you. They say, we need to study. I say, why are you studying it? Well, we got to recheck our strategic allocation and all this stuff. I said, this isn't strategic, this is tactical. You've got something that's never going to happen again, ever in the history of the world. You're sitting on this massive gain. And they actually told the committee, yeah, we got this big gain, but it's all paper. So what's the problem with saying it's all paper? You have a huge paper gain that's probably going to disappear in 3 weeks. What might you do? Maybe you would liquefy it, monetize it, right? How do you convert a paper gain into an actual real life gain? You do a trade. So this is one of my lessons. Just because you're using the word hedge doesn't mean you stop paying attention. Hedges blow up. Sometimes they usually blow up and you're negative. This is one that blew up in our favor. Just incredibly massive. I remember I was sitting next to the guy, head of HR, and is in this meeting right here. He's going, well, it's, it didn't look like it hurt us much for waiting a few weeks. It's, yeah, it probably cost a couple of $1 million. And he was like really upset after that. So yeah, they should have traded back when we were talking. Now I could have been wrong, but my argument was, what more are you looking for? Obviously I'm showing you this right here and we see the rest of this. The reason the guys and the gals in the investment company were saying sell now was because they were convinced as soon as December 31st hit, there was going to be a lot of window dressing that's going to unwind in January, that people were doing stuff in December that they were going to undo in January, and this whole thing was just going to unwind. And that's exactly what happened. It unwound really dramatically. Fortunately, they got a lot of it, but man, they walked away from a pretty huge gain. And their argument was to do a strategic asset allocation. I was like, do your strategic allocation, that's fine. I'm telling you, you should do a tactical allocation right now and just move on this thing really, really fast. And they were too scared to move. Part of the argument was, well, we told the committee we were hedging, so we can't undo this. And they were thinking they had to get the committee's approval. Our argument was, we put this whole thing on when we felt like it. The committee said hedge, and we put the swap. We didn't have to get their approval to buy the swap. We shouldn't have to get their approval to sell it. So, that didn't make sense to me. But so I don't know if you'll ever see this in your lifetime. This is so ridiculous. So why did this happen? So what is this difference? It's a credit spread. We're going to talk about credit. So why did this happen? Well, swaps are pretty safe securities because there's all this collateral sitting there. They trade pretty much in line with treasuries. And these are corporates. So swaps rallied along with treasuries, and corporates sold off because of what's going on in the market. A lot of this was the liquidity issue. There were just no buyers out there at all. That's why I say, boy, it'd be great to be a buyer in this market. So it was just an incredibly unusual market. Some of the meetings we had during this time, I was on a committee where anytime a bond had a huge move in a day, this committee had to get together. We went 2 years without a meeting. And then suddenly we were meeting like every single day. Every day there was a bond that was moving 40, 50% because it was just crazy, crazy, crazy time. So I would say there's no such thing as a hedge that you set and just go. Maybe if you're buying the Vanguard S&P 500 index fund, you're hedging it with S&P 500 futures. Yeah, that's probably a pretty safe hedge. It's going to move perfectly together. But you could tell even here that this wasn't a perfect hedge. So on something like that, you got to be paying attention because these things, man, when they blow up. And so here's what actually happened in 2008. Interest rates on the bonds actually rose. The discount rate and the liability actually rose. The swap actually came down. The surplus went from 300 million to 900 million. That's at the point where they traded. That was right here. You can imagine what it would have been if they traded back there. It would have just been just crazy time. Yeah, it was pretty amazing. All right, so that's my experience. That was very frustrating for me that they're like, at least my boss let me meet with them and guess what chart I showed them? I brought this chart in, and I didn't have this stuff over here, but we met, I kid you not, we met on this day, right there at the very, very top, very bottom. That was a Friday. We met on that day, and this is the chart I brought in. And they said, well, let us study it for a few weeks. No, please.
At what time did y'all meet on that Friday?
It was in the morning.
So
They could have done the trade that afternoon. It would have been no trouble. They're saying they need the committee's approval. It's like, why do you need the committee's approval? You know, I bought this swap and I didn't get anybody's approval. I mean, I had to get approval of the hedge, but I didn't have to get approval to buy that particular swap. So I don't think they had. I think what they should have done was sold the swap, got the money to their bond investors to go invest it. They could have given them a few days to invest it, right? You don't want to put $500 million out there and just flood the market to buy, but there would have been some willing sellers. So this probably would have taken a few days, but they could have done that immediately and gotten that into our game. And then they could have sent an email to the committee saying, hey, we don't have the swaps on because we had an unusual market condition, but in order, because you're not hedging anymore. When you're sitting right here, you're no longer hedging. Your hedge itself is a speculative bet, because these two things are so far off. So at that point, it's like, flip a coin, do something, but don't say you're hedging anymore, because you're definitely not hedging anymore. Obviously, this could have gone the other direction. Then I would have said, hey, that was my old apartment. They should have been paying, then I would have blamed it all on them. They should have been paying attention to what they're doing. I would have pretended like I would have done something if I was there, even though I probably wouldn't have. But here, fortunately, it blew up in our favor. You should have seen me watching my Bloomberg screen that week. It's like, my word, look at that thing. That's just crazy. So, all right. So there any questions on that? In finance, you can have an impact on your firm. You can have a huge impact on your firm. This stuff is serious stuff. You got to be paying attention. All right. So that's pension plans. We talked about banks. Banks are pretty straightforward. Banks manage interest rates pretty well. Banks have been doing pretty well here lately, and I think it's because rates are rising. Banks do tend to hate really low interest rates. We covered pension plans, which are pretty complex. What about life insurance? Life insurance is, I think, the most complicated of all of them. And it has to do with the type of options life insurance companies give their customers. They buy bonds, 5-10-year bonds, so they're kind of stuck with these bonds to back these liabilities for customers who have the right to take their money out. And so if interest rates really rise, their customers have an incentive to take their money out and go buy bank CDs at higher rates. And so life insurance, they're stuck with these 10-year bonds, so they now have to sell at a loss. If rates fall, they have these bonds that are making 5%, everybody else is paying 2%, so everybody wants to buy their products, and then that reduces their yields because they have to buy all these new bonds. So they get kind of hit on both sides. It's called disintermediation risk. When rates fall, they win. They get money from banks because their rates are higher than banks, but then that kills their yields. When rates rise, everybody moves their money out of insurance companies over to banks because they get better CD rates. So it's a really difficult scenario. What does all that sound like? It sounds like high positive convexity on the liabilities. Just the worst possible world. Very much like the pension plan, but with much more optionality to it. So these embedded options, they're not priced very, very well. A lot of these companies, I've been shocked. In 2008, I bought some annuities that seemed a little mispriced to me, and they had a minimum guaranteed rate of like 3.5%, 4%. I can't remember what it was, but it was a pretty high rate. So essentially, they're telling me worst case, we'll pay you 3.5%. Well, when that thing matured after 10 years, the best CD rates out there were less than 1%. I was like, yeah, I'll stick with the 3.5%. It sounds kind of nice. And I could have got my money out with almost no penalty. You know, life insurance companies tend to provide their customers some pretty lucrative options without charging them much for it. And so they kind of do it to themselves. So it's a very complicated business. So do we have actuary majors in here? I think we got a few, don't we? So win-win, yeah. I mean, win-win, you have to change between life side or property casualty side. If you like investments, you like interest rate theory, that's the life insurance side. The property casualty side doesn't really do that. Life insurance actuaries are the best in the business at this because it's so complicated. So they do balance sheet immunization, but they don't match duration. They match duration, they match convexity, and they do what you should look this up, key rate duration. You can actually find it in Wikipedia. Investopedia. But key rate duration is, you don't just match, you know, if your assets have a duration of 10, your liabilities have a duration of 11 or whatever, you match it up. No, they actually match every bucket. So we need money at 1 year, we need money at 2 years, we need money at 3 years, and they test the convexity. It's pretty amazing. The actuary that ran this for our company, he would call the investor, or the investor would call him, the portfolio manager called him and say, what do y'all need? He says, we need some 6-year duration, but we really need key rates here, here, and here. We need to fill these buckets. And the investor would say, I don't have anything like that, but I have something like this. He would put it into the model and say, no, that's too much. What if you did 80% of that and 20% here? And they would work it out, and he would get it. Man, he had it just precisely matched up, so he knew exactly what he wanted. Pretty amazing stuff. So this stuff can get, banks don't do key rate duration, but life insurance companies definitely do, and pension plans don't do that. So this is probably the most complex model I can think of. I can't think of another business that has this type of really complicated business. And you have to do some guessing because you're not really sure what your customers will do if interest rates rise or fall. I remember 2 actuaries, Alan and John. You would have thought they hated each other's guts, and they may have, I don't know. But they were debating what USA's customers would do if interest rates did a certain thing. And one guy was arguing, now these are USA customers, they're more loyal, they're not going to be hot money customers. The other actuary is saying, hey, we've sold so much new business, who knows where that business is coming from? Who knows if that's really coming from our traditional customer? And who knows what our traditional customer is going to do? If we're paying them 6%, a bank's got a 9% CD, why wouldn't they surrender and go to the bank? And they're having this big debate. If rates do this, what percentage will surrender and go somewhere else? That's a huge assumption in his model. And they were debating that pretty hotly about what assumption to do. One thought it wasn't going to be that bad. The other one thought it could be really bad. And what would you do? You're a USA customer. If they're paying you 5%, you can get your money out. It's going to cost you $25 to get your $100,000 out, and you can go to the bank and get a 5-year CD paying 9%. What would you do? Say, oh, it's USA. I'm a loyal customer. They can keep paying me 6%. I'm happy with that. Would you do that? No, of course you're not going to do that. You can say, give me my money. why would you have loyalty? They're the ones that offered you the product and said, hey, we're giving you this option. It only costs you $25 to execute. I mean, they gave you the option. Why wouldn't you execute it? You know, what's loyalty have to do with it? So very, very complicated business. I wish I could go into it more, but there's too much. It's really quite complex. If you took my life insurance class, right, Ryan, we talked about short straddles and all that. You remember that? So it's a pretty complicated business. Now, endowments, I will talk some endowments because I have a little experience here. Endowments, a lot like, well, endowment is like a charity, all right? It's something set up to fund some charitable need. Endowments are overwhelmingly, just like pension plans, overwhelmingly stocks, usually 60% stocks, 40% bonds. That's a pretty typical endowment. Most endowments are charity-like, which means they're helping people usually in need, not all of them, but usually have people facing financial hardship, they come to endowments. So let's think about the players of the endowment. There's the donors, right? Endowments have donors that come and give money. You got the portfolio itself, that's 60% stocks, 40% bonds. And then you have the recipients of the endowments. The donors are usually wealthy individuals, and the clients are people in need. So let's think through this scenario: 60% stocks, 40% bonds. So 2008 hits. What's happening to the donors? 2008 hits, stock market falls 35%. What are donors saying? Hey, I want to donate a lot more money this year. Is that what they're saying? What are they saying? You know, I gave $1 million last year, but you know, this year we're just kind of hold off, right? That's the more likely scenario. They're going to pull back. What's the portfolio doing? It's crashing. What are the recipients of the endowment doing? They just lost their job. They're in line with their hands out, right? So donors are giving less, the portfolio's lost money, and your clients are all demanding more. Sounds like a disaster, doesn't it? And that's what it is. In a weak economy with a large stock allocation, donors give less, the portfolio is losing money. They don't have a need for the tax break, right? Because they've lost all this money on their portfolio. Endowments and portfolios losing money. The 5-year duration bonds that they have are not providing much offsetting gains. And then the clients are asking for more money. So what happened to endowments in 2008? It's just absolute disaster. It's a horrible, horrible year. So endowments need something else, but they're not sensitive to interest rates. There's a little bit of that, right? During weak economies, interest rates are low, but I don't think them going out with long duration bonds is really going to help them. They need something else, something that's going to do really well. So my approach, and some students get confused on this, they put this on the exam, that this is my recommendation for pension plans. This has nothing to do with pension plans, all right? What did I say on pension plans? Dollar duration matching, okay? Get it so that your assets and liabilities with the swap gives you no interest rate exposure at all. So I'm talking about endowments here. So my philosophy is, for an endowment, when everybody is laughing, I want to be smiling. Where everyone's crying, I want to be laughing. It sounds really cruel, but this is from an investment standpoint. We're going to talk about this a little later when we talk about Taleb. Taleb is very much in this camp. I want to be mediocre 9 years, and in the 10th year, everybody else is losing a lot of money. I want to be way up. That's my philosophy. For an endowment, I think that makes perfect sense. All right, the goal in endowment is not to make bukus of money. The goal of endowment is to have a decent return and then make sure they don't fall apart in a crisis, because they need to be there during a crisis. So here's my actual recommendation for an endowment: 100% equities, but hedging those equities with options. We're going to talk about this more when we talk about price risk. I'm actually recommending endowments to go 100% stocks and then hedge those stocks. And I'll show you the math later why I think that works really, really well. Or you go high allocation to equities, but then partially hedge, you know, something that is going to give you some kind of kick. Now, Taylor, we're going to talk about him. He talks about black swan investing. He made the news in 2020. He made a lot of money at the beginning of COVID. The problem with those articles is they stopped in March. He made a lot of money in March, but I don't know if he got out in time because he would have lost it all when the market came back. So I have no idea how he came out there again. But a black swan fund is a fund that doesn't do anything for you except for once every 10 years when the market blows up and then you're making boo-hoos of money. It's just like ridiculous, huge gains. So that's kind of the strategy. But I like this strategy. I'll show you the actual numbers for this strategy. It's actually the strategy I think your grandparents should be following. So we'll look at that. Right now, your grandparents might have 60% stocks, 40% bonds. What is their bond portfolio doing? It's losing money, right? And what is the stock portfolio doing? It's pretty volatile and it's lost a little money here recently. But, right now having 40% in bonds, it's kind of dangerous, right? If interest rates keep rising, inflation takes off, that's a pretty dangerous strategy. So bonds are not all that great. Stocks look a little stretched. So I think 100% stocks being hedged is probably going to outperform the 60-40, but we'll look at the numbers and see how that works. But I do think that's a better strategy. I don't recommend this for a young investor because a hedge is going to cost you so much, you're really going to give up. For a young investor, I say just stick all your money in stocks or read my blog for a young investor. But if I were a young investor, I know if you go on a Vanguard and Fidelity and they look, for young investors, they say 90% stocks, 10% bonds. I just think that's ridiculous. Go 100% stocks. All right, we'll talk about that a little bit later, but what is 90% stocks? I hate the cap locks. 10% bonds. What is the risk here? We know what the allocation, that's the allocation of dollars, but what is the allocation of risk? Is your risk 90% stocks, 10% bonds? What is your risk? Your risk is like 98.9% stocks and 1.2% bonds, right? Because stocks are so much more volatile, you're not going to even notice the bonds. They're going to not even be there. So in that case, like I've said before, your portfolio is down 35%. I've never heard anyone say, wow, I'm sure glad I had that 10% in bonds because I lost 35. I could have lost 36. I'm so happy I did that. I just don't know anyone that thinks about risk that way. I know the models Vanguard runs says 90-10 is the right answer. I don't think we think about risk in standard deviation terms. I think I'm thinking about risk as I've just lost a whole lot of money. Find me the person that says I lost 35 when I could have lost 36 and they're happy about it. I want to meet that person. I don't think they exist, but maybe they do. But you will notice the 10% in bonds in a good bull market. It's definitely going to be dragging down your return. So it's definitely going to drag down your return. I don't think you're going to notice what it does to your risk. So that's why. But I'm not telling you to do that. You're on your own. Don't want y'all suing me in 20 years. All right. So why doesn't the investment profession focus on what matters to the client, which is asset liability risk? Investing in a way that actually hedges the risk they care about. And it has to do with how we're paid. The biggest risk in our profession is career risk. It's not asset risk. It's not liability risk. It's peer risk. And we actually even have it codified. It's called the prudent expert rule. It says, as a fiduciary, you need to act as someone with the care, skill, and prudence of diligence would have acted in the same situation. Someone familiar with such matters would act. So what it's saying is, the biggest risk you can take is be unconventional. If you want to be safe and not be sued, do what everybody else is doing, and then you're safe. And what is everybody else doing? They're putting 60, 70% in stocks and the rest in bonds. That's what everybody's doing. The safest thing you can do is do what everybody else is doing. That's one reason I was a little nervous at USA with the pension plan, hedging it, because very few people were doing that. So we're kind of out there. If something had blown up and not gone well, we could have definitely been sued by the employees for doing something we thought was very prudent. But if no one else is doing it, kind of the evidence is against us. Fortunately, we had a CEO that if he told him no one else is doing that, he kind of got excited about that. So yeah, let's do it, because he thought everybody else was wrong. And so he kind of liked being unconventional. So that kind of worked with him. But I did point out, that does create some liability risk. If it doesn't work out, it can be kind of dangerous. So the expert in the field is what we're talking about. We're not talking about the average person on the street. We're talking about an expert. And if all the experts are doing 60, 70% in stocks, you're kind of stuck with that. Your career is safe as long as you fail when everybody else is failing. Never fail by yourself. Even if there's a better strategy out there, your prudent role means most of the industry plays it safe. Following only conventional approaches. I got some really good typos in here. This leads to hurting and limited innovation. That's the industry you need to go out and radically change. You need to ask questions. Why are we doing it like this? So how did I get around this? You already know. I already told you about this. It was the what ERISA said. You cannot make any decisions that are what? Not solely for whom? The participants of the plan. So I kept playing that card over and over again. How does this help the participant? How does this help the participant? And I got as much carry out of that as I possibly could. And then again, I had a huge advantage that the chairman of our committee was a life actuary. So this is the way she thought normally anyway. If you can talk about actuaries thinking normally, they don't think normally, which is good. They think incredibly unconventionally because they just understand the statistics a lot better than finance. So she was like, yeah, that makes perfect sense. That's the way we should be doing it. Why? Because to her convention was the life insurance side. You got a liability that moves dramatically with interest rates. Obviously, we want assets that are going to mirror that. So it's kind of an easy sell for her. But yeah, you're facing this in your career of an industry that they're always looking over the shoulder, not at their clients. Their clients are here, but they're always looking over the shoulder at their peers. You don't get fired for failing with the rest of the crowd. You can actually be fired for being successful if you're not as successful as everybody else. You're up 20%, everybody else is up 25%. You get fired for not being up 25%. It happened a lot in 98, 99 when growth stocks were just killing it and value stocks were getting crushed. All these value managers were getting fired. All these people were firing them and hiring growth managers, and then they lost 80% of their money in the dot-com crash. But why? Because of career risk. There was 2-3 years there where value managers were grossly underperforming, and so they all got fired. Why? Because we were just too impatient to wait for the thing to turn. But I don't know how to fix this. There are a few solutions. The solution is not to work for Fidelity at T. Rowe Price because you're not gonna have much luck there. But I think one thing you can definitely do that I've seen. Well, why did Bill Gates think I wanted purple? So the family office, are y'all familiar with the family office? Anybody know what family office is? Oh boy. Yes. Yeah.
Right.
So I don't know if there's one right there. So it might be someone who started a new business. They made their millions or billions. And so they put all that money into a massive trust. They hire people to come manage the money. And the only person you have to answer to is that family. And a lot of times they're much longer sighted. They'll let you do things. There's some pretty good podcasts. I've heard some pretty good podcasts on these things. One of the local restaurants, I can't remember the name of it. It's one of those steak buffet places, but I can't remember the name of it. But that family made a lot of money in the 70s. And listening to the guy who was working for their family office, I thought, boy, that would be a really good job in finance, because they're letting him get away with doing some stuff that was pretty unconventional. And if it didn't work, they're like, yeah, we can see why it didn't work. It's just not time yet, but it's going to work. The market's just crazy right now. You don't get that when you're working for mutual funds. Mutual funds, you got a year, maybe a year and a half. I remember I started in mutual funds at UTSA. Everybody's like, when are we going to fire this manager? MFS, I think is the name of the firm. When are we going to fire MFS? It's like, why do you want to fire them? Well, they've underperformed last 6 months. We got to get rid of them. So we dragged our feet, and people, every time we went in the hall, when are you going to fire them? So we took so long, we didn't fire them, and then they were our #1 manager that year. And it's like, wow, like we told you, we're so glad you didn't fire them. Yeah, we knew they were going to come back. Yeah, you were telling me that. It's just mutual funds probably have the shortest patience of anyone out there. And why is that? Because mutual funds are not investors. I like what Jack Bogle says. Mutual funds are not investors, investing firms, they're marketing firms. They market performance. And what performance do they market? Whoever's done well. They would come in and talk to us like, here's 10 funds we recommend. We're like, well, what about the other 10 that you have? It's like, oh, they've had a really bad 3 years. And we're like, yeah, those might be the ones we want to look at. You know, they're probably their time's coming. Why are you just showing us ones that have done well? You know, show us the ones that haven't done well. But that's how they do. They market, and it works really well. At USAA on the 401k plan, we get the quarterly statements. I would look on the quarterly statements and see which option had the highest return. I would then call that manager and say, you're getting about $150 million tomorrow. They're like, how do you know that? Because you're the highest returning one on the list. And there's a bunch of USA employees that just got out of what option they were in. They just moved all their money to your option. And sure enough, the next day, oh, wow, look, all this money showed up. So a lot of people are chasing performance, and our industry knows that. And so we become more marketers than we have investors. Private equity, you can get away with some of this because they have more of a 10-year horizon. So that's a little bit better. You're not a public market, so you can do that. Hedge funds have a little bit more time. But hedge funds don't generally hire finance majors. They tend to hire PhDs and math, and engineers, but some of them do hire finance majors, but they tend to have a longer horizon, and they'll tend to be more patient as they wait things out. And then there's the corporate side, the insurance companies, pension plans, those type of things can have longer horizons. There are some pension plans that have longer horizon. I remember talking to pension plan people from HEB. They were a little bit more unconventional than a typical. And y'all probably have heard of the oh man, Yale and Stanford funds, their endowments, very, very unconventional. So that wouldn't be bad. What doesn't make sense with Yale's endowment is how big it is. Huh? Probably so. I don't know how to spell Harvard though. I don't like endowments. I know I had one scholarship I set up and they were like, let's make an endowment. And I was like, what does that mean? Well, what it means by endowment is you can never spend the money. You can only spend the interest on the money. It's like, so you want me to donate money that can never be spent and you're just going to spend. I was like, why would I ever do that? But that's what these endowments are. They never want to spend this money. Well, why do you think people donated to this endowment? To maybe spend it on students. And what are they doing? They're only spending their earnings on students, $53 billion. And I assure you, it's never going to get smaller than that. It's just going to keep getting larger. And what are they going to do with it? Texas has a large endowment. What are they doing with that? It's just money just sitting there for no purpose. But the nice thing is that they do some unconventional things, some pretty interesting things. I don't know if they tell you in here what they actually invest in.
UTSA does. They'll tell you what they invest in.
Yeah, you can definitely find articles. Has drawn scrutiny in recent years for its size and for its ties to the fossil fuel industry, prison industrial complex, and Puerto Rican debt. That's interesting. It's going to divest from fossil fuels. That has nothing to do with investing. That's kind of a more political move. Might make sense, maybe not, from an investment standpoint. So anyway, that's kind of the endowment world. A little bit, it depends. There's some endowments that are fairly traditional, 6% stocks to 40% bonds, and you just stick with that forever and ever and ever. But there are some endowments. The corporate side, endowments, insurance companies, there you get a little bit of freedom. I'm not saying don't go work for a mutual fund company, but I think you're going to find any unconventional ideas it's not going to make it very far. Their goal is to market and sell. They want you to do something they can sell. And you say, hey, this is going to work out really well over the next 10 years. And you say, that's fine as long as it also works out over the next month. So do whatever you want to, as long as it works every single month the rest of your life. And that's just not going to happen. So it's kind of disappointing. It does mean you got to be careful. I tell students, your first career, just take the job and learn as much as you can. Maybe your second one, but sometime in your late 20s, that's when you're going to say the next job is going to be what I passionately believe in. And then you're going to find that job. So get the experience, get it on your resume, and then start getting really, really picky. So I think you'd enjoy a family office a whole lot more than you enjoy Fidelity. Just my experience. One of the reasons I retired in 2009 was just, I hate mutual funds. There was things we wanted to do and they said, no, you can't do that because the SEC won't allow you to do that. It's like, why not? It's going to reduce the risk of our investor. You can't do that. I remember the high yield bond manager. He had a high yield bond fund and he found investment grade bonds that were higher yielding and safer than high yield bonds. Is that something you should put in a fund like that? You get a higher return with less risk. He couldn't do it because his fund was titled high yield bond fund. He wasn't allowed to buy high yield investment grade bonds. He could only buy high yield below investment grade bonds, even though he could find a better deal. They had to change the name of the fund to the high income fund. That cost several $100,000 to do, but then he could buy investment grade high yield bonds. Is that ridiculous? But that's the way the industry works. It's just a ridiculous industry. All right. In fact, one of my recommendations here is this. We started a mutual fund doing that. And the goal was to have a really nice low risk fund for retired people. And the lawyer says, that's fine, but we have to put in the prospectus that this is only for sophisticated investors because you're doing options. It's like, but no, this is for unsophisticated investors that are worried about risk. No, you can't do that. You only sell it to us. And it's like, it doesn't make any sense. So that's the mutual fund world. Any of y'all work in that world? I think I'm exaggerating this. John did. Y'all can ask John that question. I found it, and he went from AIG where he had much more flexibility, although he had nothing to do with their crisis, to a mutual fund world where there's a lot of regulations that really limit what you do. So don't worry about it your first career, your second career, but somewhere in your late 20s, say enough, I'm going to go find the perfect job, pass the CFA exam, get some experience, and then be really picky about where you want to spend your time. Don't buy the massive house and expensive cars so that you can walk away from a $100,000 job and take that $40,000 job that you really want that's going to make you a billionaire. And you can take it because you don't have that $2,000 a month mortgage. That's what you got to do. All right. Any questions on ALM risk? We'll come back to the options side here pretty soon. I'd probably still be working today if I was still on the pension plan. Because that was a lot more fun. But mutual funds. All right. Liquidity risk. Pretty quick. We'll get through this pretty quickly, but liquidity risk has really changed in definition since the 2008 crisis. So before 2008, it used to be, you don't have to worry about liquidity risk unless you need cash. If you don't need any cash, you can just sit in your investments, let them mature. So liquidity risk is, boy, you might need $10 million next week and the only asset you have is a building. And you're not going to be able to sell a building in a week. It's going to take months. So that would be liquidity risk. But if you don't need the money for 5 years, 10 years, yeah, that building's a good investment. Forget about liquidity risk. And then 2008 came along. So prior to 2008, liquidity risk was defined as the inability to obtain cash quickly when needed, absent a fire sale. And a fire sale means the act of selling the asset, you have to do it so fast that that sale causes the price to fall. So like I'm selling my mom's house. What if I called the realtor and say, hey, I'm selling my mom's house. I'll give you 3 days because I need the cash. Could she do it? Do you think she could sell it in 3 days? BlackRock would probably take it. How much of a discount would it take? A lot, but I think I could sell it. I think some of these cash for houses people would probably take it, maybe for 350, 400,000 when its market value is, around 550. But that act of selling it would drop the price. If I could wait 3 months, I would get a lot more value. That was the old definition of liquidity risk. So if you don't need the cash, you don't care. The problem was what happened in 2008. Well, let's talk about illiquid assets. Well, let's talk 2008. I'll come back to illiquid assets. After 2008, the definition changed because markets got so illiquid in 2008. Illiquid bonds that would normally drop 5%, 6, 7% in liquidity crisis were dropping, I kid you not, we're dropping 80%. Bonds that look perfectly fine, that we're going to pay off, were dropping 80% because there is no liquidity. Now, if you don't need the bonds to be sold, but the price is dropping 80%, you're going to notice that that's going to be an issue for you. You're going to do something with that. You can't say, well, hey, don't worry, we're going to hold it to maturity. The bond market's telling you maturity is not going to happen. This bond's going out of business. And you might completely, I remember on CMBS, commercial mortgage-backed securities in 2008, they got caught up in the whole asset-backed and they sold off a lot more than they should have. And all the investors like, this doesn't make sense. These bonds should not be trading at these values. It didn't matter. They were trading at those values. They were dropping 60, 70%. So it became a thing. And now maybe 2008 never happens again, but 2008 was such an extreme liquidity crisis that you had to care, even if you had no plans of selling. So the definition has changed. But illiquid assets, that's like real estate, corporate bonds. Corporate bonds are fairly illiquid. It's hard to sell them really, really fast. You can in a few days, but it's hard to sell them as fast as stocks. Stocks are very, very liquid. Now, I know you're thinking, well, stocks are really volatile. They are, but you know, if I sell 1,000 shares of Apple stock, that's not going to cause Apple stock to fall. My sell is not going to cause Apple price of stock to fall. Their price might fall, but it's not because, wow, Ron Sweet's selling Apple stock, everybody get out. They don't care what I'm doing. In fact, if they see me selling Apple stock, they're probably going to run in and buy it. They're going to say, yeah, we're going to do the opposite of what he does. He's a college professor. He can't possibly have it right. So, you know, stocks are very, very liquid. Maybe as liquid as treasuries. I mean, they're extremely liquid things. But corporate bonds are not that liquid. So if you need to sell a corporate bond really fast, you're probably going to take a price hit. And if you try to sell a corporate bond in 2008, you're going to take quite the haircut. It's going to be quite intense. Liquid assets, stocks, treasuries, agency bonds, asset-backed securities, exchange traded derivatives like options, futures, those are very, very liquid. In fact, in 2008, it got really interesting. Futures are so liquid that in 2008, there was some disconnect between futures and the underlying assets because the futures were so much easier to sell than the underlying asset. The two markets got out of whack. And if you had money and you had time, you could have set up some really good arbitrage trades in 2008. I remember seeing one where I almost quit my job just so I couldn't do the trades because of my job. And I was like, I want to quit my job just to do that trade because it was just so ridiculous, those opportunities. But it was this liquidity thing. People sold what they could, which was the most liquid things, and the things they couldn't sell were getting mispriced. And boy, if you had money, it was a great, those type of market disruptions. That's why I say Oak Tree Capital. Have y'all heard of Howard Marks? He's got a great podcast. He talks about 2008. They were putting like $500 million, I think, a week into the bond market in late 2008.
Everything was at a discount.
Oh yeah, and people are like, "Are you crazy?" And he was like, "No, you got to jump in when everybody's selling." So, yeah, Howard Marks is a good guy to read. He's an interesting character. He's Mr. One-liner. If you listen to him, he'll be writing his quotes down and putting the quotes up on your computer at work for encouragement. He's Mr. One-liner. He's the one that said, "There's no bad assets, only bad prices." That's a great quote. So very famous guy. But he was buying bonds, and just like I was trying to get USAA, sell the swap and buy bonds. This is the time to be buying because everybody else is selling. So these are very liquid assets, can be sold very, very quickly. I'll tell you one exception. I've told some of y'all this story before. I remember in 2008, I might have already told you this. I can't remember. I can't keep one class straight from another. But we were doing options in 08, so we had a few $100 million in option trade that to our favor. So I go to Donna's desk and say, I got $300 million showing up tomorrow, or whatever it was. And she's like, what do you want me to do with it? It's like, well, I'm just telling you, it's showing up tomorrow. She said, I can't buy anything. There's nothing to buy. And I said, well, just stick it in T-bills for now. And she goes, no, there are no T-bills. Have I told y'all this story? No. And I thought she was joking. And she kind of has that kind of, dry humor. So I was like, yeah, funny, Donna. Yeah, right. Just no, there are no T-bills. It's like T-bills is the most liquid asset in the world. How can there be no? She said, no, everybody owns a T-bill, is clinging on to them for dear life. They're not selling them. In fact, they have negative interest rates. If you want to buy a T-bill, you're going to pay more than you're going to get back. So if I buy T-bills, I'll actually lose money. So no one is selling me T-bills. And so I said, well, it's your problem because you're the bond manager. So sorry. We're good friends. She didn't disown me after that. But yeah, it's like, why can't you buy? There was nothing for her to buy because it was such an illiquid market. She could have bought stocks, but she was the bond manager. She couldn't do that. But nothing, there was just nothing available for her to buy.
Is that when everybody did the flight to safety?
Yeah, it was a flight to safety, and then those that already had the bonds were just clinging on to them. It was a pretty wild market. And this is an issue for the Federal Reserve in 2008 because Federal Reserve, they had to make a decision on firms like AIG and Lehman and General Motors and Washington Mutual. They had to decide, is this a liquidity crisis or is it a solvency crisis? If it's a liquidity crisis, the Fed steps in, loans money. They get through the liquidity crisis, they survive. If it's a solvency crisis, the Fed steps in, loans money, and they just wasted a bunch of taxpayer money. So they have to make that decision. That is not an easy decision to make, especially with a firm as complicated as Lehman. You don't really know what Lehman and Merrill Lynch actually own and what that value is. They have these really complicated balance sheets. If the Fed gets that wrong, they're going to cause a bigger disaster. Either way, if it's a liquidity crisis, but they think it's a solvency crisis, they're going to cause a solvency crisis because these firms are going out of business when they shouldn't have. If it's a solvency crisis and they act, they're just making the problem bigger down the road. People tend to think the Fed did a fairly good job. I'm trying to Paulson, what's his name?
Paulson.
Forget his name, the Goldman Sachs guy. They generally give him pretty good marks for handling this. I would not have wanted that job. Any of y'all want that job at the time? No matter what, if he bailed someone out, it's because he's from Goldman Sachs. He's bailing out his own industry. Yeah. If he doesn't bail them out, it's like, how can you be so stupid? And when Lehman went under, boy, that was like the end of the world. We were just absolutely shocked. So that was just amazing that week. And Merrill was going down next. If Bank America had not bought Merrill, it would just been an incredible disaster. So the Fed had that question to try to figure out. They decided Lehman was a solvency issue and let them go under. They decided AIG couldn't go under. I kind of understood that one. I talked to some firms that AIG was their main insurer, and I said, what are you going to do when AIG goes under? And they said, we will keep buying insurance from AIG because they are the only ones that sell what we need. There's no one else for us to go to. So yeah, we'll have no choice. We've got to keep sticking with this firm. Washington Mutual went under. Yeah. That didn't seem to cause too much trouble. So it's interesting. Y'all should get John. We should have John Tui come talk about the AIG crisis. It was fun interviewing him during that time because you interview him, and every time he introduced himself, John Tui from AIG, and no, it wasn't my fault. That was his introduction to every meeting. I didn't cause it. It wasn't me. Really tough time to be working for AIG back then.
He says that the only reason why the Fed actually stepped in to provide the loans because the AIG actually had assets to back up the loan, whereas Lehman didn't because nobody knew what the prices were on the mortgage-backed securities or the collateral.
Yeah, no, it was worth it.
Nobody knew what.
And Lehman's a very different business. You think about Lehman. This is Lehman and Merrill and Goldman. These investment bankers, they're short-term funders. They're out in the market almost every day. If the market loses confidence with them, they're done for because they're constantly borrowing money just over and over and over again. And so it's a really dangerous business. And that's why Goldman and Morgan are rebuilding their balance sheets, adding deposits, making themselves look more traditional to kind of get that exposure to the market a little bit lower. How do you measure liquidity risk? Because there's a definition. It used to be if you don't need cash, don't worry about it. You need cash, you need liquid assets. After 2008 and the liquidity crisis, everybody cares because prices are falling so much. How do you measure it? There's really no way to measure liquidity. There's no number you can look at. You do want to worry about your exposure to a particular industry or a particular company. So that can be important. One thing you can do on liquidity, you've probably seen this in your banks, is stress test. You can run a stress test to try to see what would happen in this scenario to these entities and try to figure that out. If you can do stress tests, I say go very extreme on your scenarios. We're going to talk about unexpected correlations later. We talk about Doug Hubbard. What Doug Hubbard says is at the extremes, things that weren't correlated suddenly become correlated. You would never imagine them being correlated, but then at extremes, things just suddenly become related that you just would never think of. So those are kind of extremes you've got to go to. But one thing, I heard this on a podcast, I thought this was really good. So one question might be, where is the next liquidity crisis going to be? So in 2008, it was all the subprime and the asset-backed securities. 2000 was all the .com. So where's the next liquidity crisis? And they said the next liquidity crisis will be today's most crowded trade. So where's money flocking to today? And if you find that out, that's probably going to be the unwinding liquidity crisis in the next few years. So try to figure out where's money going today. I don't know if I can answer that today. Because everything's so expensive right now. Some people are starting to worry about real estate again. I don't know, does it make sense? I was talking to in my earlier class, my mom's house, you know, I could probably sell it for $560,000. She bought it for $170. I don't think that house would sell for more than $300,000 in San Antonio. I just don't see how it possibly could. Does it make sense for a house? It's a pretty dull house. I mean, I think it's like 1,800 square feet. Not much to it. I mean, there's a nice oak tree in the front. But would you spend $560,000 for that house? 20-year-old house, has serious foundation issues. But location, I mean, it's a nice street.
But
It's not the kind of house
It's in Austin, right?
Yeah.
Yeah, there's a lot of people moving out there.
Yeah, people are moving to Austin.
New homes.
And it's-
People get paid well out there, so they're just like. "Eh."
Right, and some really bad zoning restrictions. But yeah, so it could last. I think that's the key. They can't build new houses,
Yeah.
especially multi-level. So it's some of that's the political issues.
I
But
think I read an article saying that a lot of the buyers that they're buying today, to maybe 6 to 12 months after they buy the house, they hate the house. And they only bought it because it was a fear of missing out on the low rates.
yeah.
So when those people get tired of the house and they put them back on the market, that's going to drive the price down.
Well, then you think about the construction side. There's no way it costs $560,000 to build this house. There's no way the material in this house is worth that. So if the zoning laws change, people could build houses pretty quickly. But it seems like a really, really wild market to me. But is that a crowded trade in Austin that people are like, hey, I've gotten so many emails from people wanting to buy my mom's house for cash. I'm like, how did you even get my name? This is crazy. On my text, I get this text, this guy is really friendly. Hey, Ron, good to see you, man. And it's like, I don't know who this person is.
I got
How did he get my phone number?
I got a phone call today from a guy in California saying he's going to take a flight next week and he wants to tour my house, my mom's house. I'm like, we're not even selling the house.
Yeah.
Like,
Oh, they said they want to buy my condo for $120,000. It's like, it's not worth it, but yeah. Crazy, crazy, crazy. So I don't know if real estate could be a crowded trade. It certainly 2008 was part of that crowded trade. So I don't really know where the most crowded trade is today, but I would be watching for that. If you notice a lot of money is moving in a place that hasn't moved there before, whether it's emerging market debt or emerging market equity or commodities or whatever, you know, certainly be watching to see what happens if that unwinds. And one thing you can definitely look up, we might have talked about this before. I don't know how to spell it. Let's see if we can find it out there. Minsky kitten. I don't know what that is. But Minsky moment. There it is. Have y'all heard of Minsky moment? Anybody?
When they pull the rug.
So what he's talking about is markets go on a fairly predictable pattern. So at the bottom of the market, institutional investors come in kind of quietly. The retail investor is finally selling. They've had enough. They can't take it anymore. And the institutional market investors coming in. That's why the bottom of markets are really easier to call than the top of markets. Because there's, first of all, you can see retail investors. They're really obvious because they do odd lock trades. They're in certain type of investments. Institutional investors aren't as easy to see, but there are some certain types of trades you can see. And then asset prices start going up. And so other people start buying and asset prices go up. And then people start noticing, wow, asset prices going up. Then you start getting some of the retail investors, and then people start borrowing money to buy the assets because of the fear of missing out. They don't have the money, but they're going to borrow money. And then you get this frenzy of people borrowing money to buy these assets. The asset prices really shoot up. Now you have these people are very levered buying these assets, and then the asset price falls just a little bit. If you borrowed a whole lot of money to buy an asset and its price just fell a little bit, you're in a lot of trouble, right? Your investment bank is asking you for collateral and all this kind of stuff. So what do? You sell fast. What happens then? The price starts falling more. Then you get this crash, and then it starts all over again. So that's his argument. So he says, according to hypothesis, the rapid instability occurs because long periods of steady prosperity, investment gains encourage diminished perception of overall market risk, promotes the leveraged risk of investing borrowed money instead of cash, the debt leveraged financing of speculative investments exposes investors to potential cash flow crisis. That sounds like what? What's another word for potential cash flow crisis? Sounds like a liquidity crisis, which may begin with a short period of modestly declining. So the prices don't just drop. They drop enough that those levered investors, they got to do something. They're starting to get a little worried. In the event of decline, the cash generated by assets is no longer sufficient to pay off the debt. Losses in such assets prompt lenders to call in their loans, right? They're starting to get a little worried. Their collateral is not worth as much. This rapidly amplifies a small decline into collapse related to the degree of leverage in the market. Leveraged investors are also forced to sell less speculative positions to cover their loans. It gets back to you don't sell what you should, you sell what you can, because it's kind of domino effect. No buyers bid at prices recently quoted. Boy, we saw that. The toughest thing we had in 2008, our bonds might be on our books at 95. So 5% loss. And there hasn't been a trade in that bond for years. So we're using model prices. So the broker says, yeah, our models say that's worth 95 based on everything we have. So okay, it's fine. And then suddenly the price drops from 95 to 60. And so our committee gets together and say, why did that bond price drop from 95 to 60? And they say, well, some guy in Minnesota sold 10,000 of the bond because they needed some cash. So we now have an actual price. And we now have an actual price. We've got to do something with that. We can't ignore that. You know, it's kind of like me selling my mom's house for $300,000 because I need the cash. Well, now, if you're trying to market value houses, you now have a price of a house in the neighborhood. You might say that was a fire sale. You can't use that. But if it's the only price you have, what does gap accounting say? You got to use it. It's got to be in your analysis. We actually had it where you would call a broker and say, can you give us the model price? They say 95. You go back to the portfolio manager, 95, that's great, let's do it. So you go back and say, yeah, we want to sell at 95. Says, oh, you want to sell? Then the price is 70. We didn't know you want to actually sell. So yeah, the model price is 95. That's what it should be. But if you want to actually sell, it's 70. That's the kind of things that are happening. That's what a liquidity crisis looks like. Further declines, this starts off a major sell-off leading to a sudden and precipitous collapse in market clearing asset prices, a sharp drop in market liquidity, there's a low liquidity, and a severe demand for cash. This Minsky cycle consists of a repetitive chain of moments, back and forth, back and forth. If you do Minsky moment and look at the images, you'll see all kinds of these type of graphs where, you know, it goes up and it shoots back down. So there, boy, is that Minsky? Well, he could be the Joker in Batman. So you'll see these type of charts. There was a big debate in the Financial Analyst Journal. One guy just thought this was a terrible theory, and I didn't like his argument. Didn't make sense to me. His argument was every borrower has a lender. You're just left pocket, right pocket. That didn't really make sense to me. But he argued it in the Financial Analyst Journal. Several people challenged him, and man, he got just really mad. He started calling people names. So I don't think his argument may have been too strong. But yeah, the Minsky moment is definitely, he's trying to explain this liquidity crisis. Why did they happen? A lot of it has to do with debt. Too much debt, going after assets, assuming asset prices keep rising, and they don't. Okay. I do want you to read through the liquidity section on your bank. I don't know when that paper's due. I think we got some time. It's kind of a weird thing. I'll show you one or two of the best papers. I'm not going to put a good paper out there because too many students are like copy and paste time. I don't like it. But I'll show you some of the better ones. That I can't really show you a paper for your class because they had an extra section on credit risk that you don't have, but just to give you some sense of what it looks like. So, right. So now we're getting into, I think, a really, really interesting topic. Price and market risk. And we can do a whole lot with price and market risk. Y'all can see I'm being intentionally confrontational in this class. I want to really, I'm pretty sure I'm wrong on everything, but I'm at least like to think unconventionally. And I want y'all to start challenging everything you ever learn. I don't want you to believe anything I've said other than rethink everything you've ever been taught. All right. So I'm trying to just kind of pull the rug out from under your feet. All these classes that gave you these wonderful beta and standard deviation, this is how it works in practice. It's like, no, it doesn't. It actually doesn't work very well at all. That's why 2008's happened. And especially, you can see on balance immunization, I actually think finance can do really great stuff there. That's one area we're really quite effective. This is where I actually think we're the worst. So you can get my most cynical self in this part of this discussion. And it really comes back to that career risk. We tend to do badly here because we're not compensated well to actually manage those risks. So we're gonna get into it. We're gonna talk the traditional approach, the value at risk. We're gonna do quite a bit of value at risk. And then I'm gonna challenge, one thing I'm gonna challenge, you're gonna be shocked I'm gonna challenge this because I think a lot of you are gonna think, how can you possibly challenge this? But I'm gonna challenge the whole concept of diversification. Does diversification actually work as an investor? That's pretty shocking, isn't it? So I'm gonna say, maybe it doesn't work the way finance says it should. All right, so I'll let you have 3 minutes early. You can go work on your paper. There's a scholarship available from the Insurance Council of Texas. They used to coordinate it through me so I could kind of control, and I'd send recommendations, but they don't do that anymore. You have to apply yourself. It's due pretty quick here, February 28th. Almost everyone that wins it comes out of this class or my next class. Probably because no one else knows about it. I tell other professors that no, I'm the only one who actually announces it. The biggest requirement on this is that you want to work in the property and casualty insurance industry. So if you have no desire to work in that industry, you're not. That's how they actually pick the winners. So if you're actuarial science major, you have a really good shot because obviously actuary science majors want to work in the industry. But you have to talk this industry. I had one actuary major say she really wanted to work in life insurance, and they kicked her recommendation out. I recommended her and they kicked her out just because she said life insurance. If she's just taking the word life out and said, I want to work in the insurance industry, she might have been okay. So that's the key. They used to give us 5 $1,000 scholarships. Now they don't do that. They say, hey, we can give 5,000 to one person. We can give 1,000 to 5 people. Last year, they gave 2,000 to one person and 1,000 to another. I don't know how they come up with that. I have no control over it now. So it's completely out of my hands. However, if you go to our website, it's just insurancecouncil.org. Under Education Foundation, if you click on the scholarship, there's the application. The key is what you say there. So if you want to apply, if you type this and send it to me, I'll let you know if you have it worded in a way that might. They love sob stories. I came from a country and everyone in that country is dead now. I'm the only survivor, and I really want to understand hurricanes and whatever, something that really helps. We've had 2 UTSA students actually speak at the symposium And one guy from China, he had them all in tears. He had a really incredible story about his journey over here. So, you know, they like that kind of stuff. So your own story, and then your interest in the industry. If you've worked for an insurance company, it works. Now, the nice thing about this is USAA is one of their biggest members. If you work or have worked at USAA, it doesn't have to be on the PNC side. You don't have to divulge that you worked at the USAA bank. You just say, hey, I worked at USAA, found it really interesting. You know, you can kind of get around because they see USAA, they're going to think. And a lot of these companies that are members have both life insurance and property casualty insurance. So, you know, are you an active member of Gamma Lambda Sigma, which probably is no one here? All right. So I'd recommend, I don't know why it typed data analysis for me. I didn't click on anything. It's a good scholarship money-wise. And also, if you're trying to get into the industry, they actually have a pretty good recruiting database that they'll help you. It's not too actuarially focused. However, if you go to the symposium, there's a lot of actuaries at the symposium, and UTSA will pay for you to go to the symposium, and you can really make some connections there. I remember last time I went, there was probably, I don't know, 10 or so USAA actuaries there. So it's an opportunity. Any questions on this? So if I have, you know, I'll probably pester a few of you that I know you have an extremely high probability of winning. The lady that won 2000 last year, I was like begging her to apply. Would you please just send it? Okay, I'll do it. And it's like, okay, now you got $2,000. So all right. So we get in price, before we get in price risk, someone asked me today, so on this borrowing to invest, do you want us to view it from a pension plan standpoint? So it got me thinking, what other standpoint is there? So if AT&T went out and borrowed $2 billion and stuck it in the stock market would freak out. It's like, what in the world are these guys doing? That would just be so ridiculous. I mean, can you imagine AT&T? You know, we really think the stock market's cheap, so we're going to go out and borrow $2 billion and put in the stock market. You know, you AT&T stockholders, you should really thank us for that. No, they would kill the stock price. And yet I'm arguing that's exactly what they're doing by borrowing money from their employees and sticking in the stock. To me, there's absolutely no difference in the two, other than if they went out and borrowed money, the bond market 5-year debt, it's a lot different than a 30-year, 40, 50-year pension liabilities. So it's even worse because the way they're borrowing money is extremely high betas. So so yeah, you know, I know y'all are really wishing the AT&T guy could come here and have a public debate. I would enjoy it. All right, so we're going to move on into price risk. There's a lot of issues on price risk. The definition is real straightforward. Asset falls, the liability rises. So what we just covered with interest rate is a special case. So how are we going to measure price risk? You've had all these in your stats classes and in your finance classes. You're probably getting tired of them. We'll definitely use standard deviation. If we're going to talk on Neeson Taleb here, his hatred of standard deviation. What does standard deviation assume? Nice symmetry, everything's, you know, there's no issues with the tails of distribution, things are nice and symmetrical. Assumes a normal curve. Is that true in finance? It's true until it's not, and when it's not, that's when you really wish it were true, because when it's not true is when it's really to your detriment. We will not do beta in this class because this is not, we'll talk a little bit about beta when we talk about diversification. Because beta is an interesting concept. Beta tells you to ignore 80% of the risk of a stock when you buy it. That's what finance tells you. That seems pretty radical, doesn't it? Hey, I'm going to invest in Apple stock. Oh, well, you can ignore 80% of the risk of that stock. Now, why does beta tell us to do that? Doesn't that seem irrational? Anybody remember, what does beta say? Hey, ignore 80% of the risk of that stock. It's not important. Completely ignore it. I've had this, what, 20 times before? I know some of y'all know it. All right, yeah, I mean, come on. Humor me. Why do you ignore 80% of the risk of Apple stock when you buy it? It's unsystematic. Yeah, 80% of the risk is unsystematic. It's going to disappear when you diversify it in the rest of your portfolio. Y'all believe that when you buy Apple stock, you ignore 80% of its risk? I bet when you buy Apple stock, one of the biggest things you talk about is this unsystematic risk. It's new product coming out or those kind of things. So anyway, we'll definitely be talking about value at risk. We'll be doing parametric historical. We won't be able to do stochastic, although, you know, some of y'all could probably show me how to do some stochastic. You can certainly use the random number generator in Excel and do some cool stuff, but we're not going to do that. So we're going to be doing parametric and historical. You're seeing a lot of stress tests in your bank write-up. You know, banks do a lot of stress tests for credit, for liquidity, for price. So we're not going to do stress tests here other than what we did under the interest rate risk, where we did plus or minus 100, 200 basis points. And we won't use duration convexity here because that was back under the interest rate risk. So our main focus is going to be standard deviation and value at risk. So it's parametric value at risk. You use the following very, very simple formula. You take the average. Another word for average is the expected value. What do you expect on average? Minus some number related to your probabilities, the number of standard deviations. The more standard deviations you go away from the mean, the lower the probability. Times the actual standard deviation. So if you have a curve that's real steep and a curve that's real flat, which one has the higher standard deviation, the steep one or the flat one? The flat one. All right. So when did y'all have stats? Has it been that long? For y'all like I was in stats, it's like, man, I'm glad I got out of this class. I'll never use this again. And then it ended up being the most important class I ever took in college. So yeah, the flatter the distribution, the greater the standard deviation, the more risky something is. But there's a huge dependence on standard deviation. So how rare are events? So let's a 1.64 standard deviation. How often does that happen? Some of y'all, your banks uses a 5% risk tolerance. How many standard deviations is that? 1.64. Anybody remember what is a 1% event? You remember? 2.33, yeah, very good. So 2.33 is a 1% risk. Let's fix this a little bit. What would be a 4 sigma? How often do we get 4 sigma events? Let's do 1,000 years. In 1,000 years, you would not see one of those. Does that make sense? 4 sigma event in 1,000 years, you wouldn't expect to see one. What about in 1,000,000 years? So in 1,000,000 years, you would expect to see 32. 4. What about a 6 sigma? How often does that happen? In 1,000,000 years, do you think you'll see one? In 1,000,000 years, you wouldn't see a single sigma event. What about 10? It's never happened in the history of the universe, right? Bill Gates can't even find it. Like, can't exist. So why in 2020 do we have a 10 sigma event? Why in 2008 do we have 4, 6, 7 sigma events all in the same week? What does that tell you about the normal distribution of what we're looking at? Either we saw 4 once in a billion trillion years in 1 week, or there's something wrong with the statistics. Bill Gates stops at 10. We've had events that are far greater than 10. October 87 was a 23 sigma event. How often does a 23 sigma event happen? That should never happen. So there's obviously something wrong with this approach. But what finance argues is most of the time, stock markets and other markets, they're fairly normally distributed. Yeah, every once in a while they get a little wild, but most of the time they are. So here you're going to get one of my, some of my cynicism here. Why are we using standard deviation? Help us measure risk. Why? So we can manage risk. And everybody says it works well most of the time. When doesn't it work? When risk is killing you the most. All right. So, go buy a gun to protect your family, and on the side it says, will not work in case of intruder, will not function. Go buy a fire extinguisher. It will not work in extreme heat. That's what finance does. Our systems work really, really well unless you need us, and then they're not going to work. An airbag will not work in case of accident. That's essentially what we have. So these things work really, really well unless you have 2008, 2001, 2020. They don't work when you most are worried about risk. But we'll use them and we'll walk through them and we'll see how they do work. So 233 is a 1% event. So you would take your mean minus 2.33 of those times your standard deviation, and that loss would be expected to happen or more 1% of the time. So if that's 10%, then you'd expect to lose 10% or more about 1% of the time. Now I love the actuaries at UTSA because they said, that lose 10% or more. Guess what they were most worried about in that phrase? They focus on the or more. That's what they were worried about. Oh, so I can lose 10% or more 1% of the time. So what does that or more look like? And they actually want to do the distribution of the tail, which I think was really, really cool. So we always express VAR. You're going to get a negative number when you calculate it, but you always express VAR as a positive number. So if your VAR is, you do the numbers, you get negative 10%, you just say our VAR is 10%. We expect to lose 10% or more because we just know it's a loss. I don't know too many VARs where your worst case is you make 4%. So those are the measurements. You should definitely know standard deviation from memory, beta from memory, correlation from memory. Those formulas, we use them so much. You really should know them, have them memorized. I think I got at least 2 promotions just because I knew those formulas. It's kind of pretty cool. It's like, oh yeah, I know that. I could never impress the actuaries, but I could impress accounting and finance people that forgot their stats classes. All right, so that's how we measure. So we'll focus on those two, standard deviation and VAR. And then how do we mitigate it? We mitigate it through diversification. Number one tool. So I'm actually going to question, does that actually even work? So we'll talk about that. So correlation, don't have all your eggs in the same basket. We're going to get into this formula. Hopefully you know this formula, but if not, we'll get back into it. That correlation at the very end of it, very, very important. And you'll actually be using this formula on the second exam, not on the first exam. The first exam, it stays pretty basic, but correlation, extremely important in finance. The other thing we use, and you probably have seen, not risk budgets, that term's kind of going out of style, but risk limits. You've probably seen risk limits in your banks. So risk limits is not a measurement, it's a mitigation. All right, so value risk is a measurement, risk limits is a mitigation. Why is it a mitigation? Because it says we cannot exceed this amount. That becomes, that's like the fence you put around your risk. So you cannot lose more than $50 million. If our VAR is 60 million, we've got to do something to reduce our VAR. So it makes you reduce your risk.
Would risk limit be the same as like risk appetite? Because that's what it says in my energy.
Risk appetite, yeah, it could be. Yeah. They're actually saying that in risk appetite in their annual report. Yeah. Boy, I could see some people putting a risk tolerance with risk appetite too. So I don't know if that says technical as a term as risk budgets or risk limits. That would be interesting to see. Risk appetite, it's actually there, risk appetite definition. Yeah, in this definition, it is the same. You do risk budget. No, that's not it. So what is a risk budget? It's an asset class says. So risk budget is really kind of a squirrely term, I guess. It's lost its meaning. Risk limit is a threshold used to monitor the actual exposure of a specific risk or activity unit to ensure that the level of actual risk remains within the risk tolerance. That's a really weak definition. The risk limit to me is remaining. It is what you're allowed to lose. So if you think about it, VAR is what you think you can lose. The risk limit, the risk budget, the risk appetite is what you're allowed to lose. You compare those two and you make a decision. So you're probably, if you don't have the word limits in your paper, I would definitely do a search on the word limit. It should be, I can't imagine any of your banks don't use the word limits somewhere. It's a pretty common term. And it's just your budget that you have for how much you can lose. So value at risk is how much we expect to lose. The risk budget is how much we're allowed to use, given some risk tolerance. They might ask, how do we come up with the risk tolerance? Why do we pick? You know, I think Goldman Sachs they use 5%, right? Not 10, just 5, I think, if I remember correctly. That seems like a really aggressive risk tolerance for a bank. You think they would use 1%. And I don't think any of your banks use 1%. I think 5 is a pretty common number. That seems like, I mean, that's 5%, you know, in a year, that's 10 or more times they're going to exceed that number. That's a lot of times where you exceed the numbers. So I'm not sure what it does for it. UTSA, they used 0.2%. So I don't, you know, I know how they came up with the 0.2, but is that the right answer? Why not 0.1? Why not 0.05%? You know, how do you? So the general way you come up with the risk tolerance is usually tied to your credit rating that you want. If you want to be AAA, you're going to have a much lower risk tolerance than if you want to be BBB. So that definitely influences. All right, so you select your risk tolerance. Closer to 0, the lower your risk tolerance. Usually tied to credit ratings. For individuals, who knows? We'll talk a little bit about that. Can you really objectively measure the risk tolerance? And people have tried this. We'll look at this survey and see what is your risk tolerance. To me, the most important thing is your age. The younger you are, the more time you have, the longer the horizon, the more risk you can tolerate. The older you get, the closer you are to retirement. So I think of young people have a risk tolerance, say of, or the average American family is 1%. Young people might go up to 5%, and older people might be 0.1%. But who knows? It's pretty random stuff. I'm trying to guess what that is. So don't ask a financial planner this. You know, how important is assessing someone's risk tolerance? Because they'll put on their serious face and start talking about it. Mm-hmm. But when they really come down to it, can we actually measure this? They really have a tough time with it. So this is UTSA's. I'm willing to lose money in the short term if it means I'll make more in the long term. First of all, what's the quality of the question? You're asking someone who has no knowledge of investing. I'm willing to lose money in short term. It makes, let's say you're answering this question in, I don't know, 2017, 1999. The stock market's been up for an entire decade. And you're answering this question. How do you answer it? Oh yeah, man, I lose 5. Yeah, the market goes, I actually go out and buy more. Yeah, I've got a lot of risk tolerance. What if you're answering this in November of 2008? It's like, no, I give up. I'm in cash. So think about that. I do not panic when a stock loses money. What did they say in 1999? Yeah, I don't panic when. Yeah, I'm used to volatility. I can take it. I mean, sure, my stocks have been up 10 years in a row, but man, when they go down, I'm going to be ready for it. what did they say in 2008? It's like, I am panicking right now. Why are you asking? And then I think what's interesting is I have this thing at the end, maybe. What are they going to do with the maybe answer? I mean, they're going to take that number and they're going to assign a stock allocation to this person. What are they doing with the maybe? I am an informed investor and stay current on economic news. Should informed investors have a higher stock allocation than uninformed investors? Does that make sense? How many years into, ding, 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 finally, a question that makes sense. How many years until you expect to retire? Finally, a horizon question. 100% stocks, 60% stocks, 40% stocks. Yeah, I mean, it works pretty well. What I did is I went through, I'd answered this, every single possible combination I could answer. And I was shocked at the different asset allocations. So I went to the financial planners and said, do you realize if I answer maybe here instead of no, my stock allocation goes from 40% to 70%? Are you aware of that? And they're like, no, we researched this. It's all been studied. I said, where did you research it? I'm kind of curious. So they don't like the question because they don't want to deal with it. I think finance planners know you really can't assess someone's risk tolerance. It's just not possible, but they try with questionnaires. I think to me, the best questionnaire out there that I've seen is the Ibbotson. Just because, you know, he's pretty good at this. He's got a good background in understanding risk. I think he was bought out by Morningstar, so he may not be able to. It's going to be similar types of questions. But I mean, it makes a big difference. 30%, 50%, 96%. And again, why 96%? Why not 100? It's just, I don't. Yeah, we put you 99.8% in stocks. I don't. Why? What are you trying to do? There's expected return, expected standard deviation. Based entirely on how you answer a few questions. So my big problem with these risk tolerance questions is people answer the questions differently based on what markets have just done. And if you really think about it, what the questions do is they cause people to sell high and buy low. I mean, it's the sell low and buy high. Yeah, sell low and buy high. After a horrible market, they get real conservative on their answer, and so it pushes them lower in stocks, so they actually sell stocks right when they should be buying them. If the market's been up for a long time, they're much more aggressive, so it puts them more in stocks right when they probably should be cutting back on stocks. I think it's like the opposite of good risk management. I think it actually harms you, but I don't see the actual question there. This might be it. What is your age? I don't know why they already answered it for me, but that's actually correct. When do you expect to start drawing income? What is your goal for this investment? To grow with caution. Does a retail investor know the difference between you grow with caution or to grow moderately? To grow significantly, to grow. All right, so there's going to be a huge difference in your stock allocation. Are you growing aggressively or significantly? Boy, I don't know the difference in those two. Assuming normal market conditions, what would you expect from this investment over time? Suppose the stock market performs unusually poorly, what would you expect from this investment? So, you know, they're interesting questions. So it's tough for the individual. It's really, really hard to say what is your risk tolerance, because some people have said, well, you go bungee jumping, skydiving, but there's no evidence that people who are risky in their hobbies are going to be risky investors. There's no reason to assume those two parts of our lives. Wow, you're a really dangerous driver, we're going to put you 70% in stocks. There's not that correlation or understanding of risk. So, all right, so I'm going to give, now you're going to have to do this on the project, but we're going to keep it pretty generic. If you're doing your project for a young person, then maybe use a 5% risk tolerance. If you're doing it for an older person, maybe you go below 1, but you know, it's fairly subjective. You didn't calculate the VAR, which is very easy to do, and then you compare your VAR to your budget. If your VAR is less than your risk budget, you can take more risk or do nothing. If it exceeds, then you got to do something. So it's pretty straightforward. So on the first exam, we have some fairly simple questions, and they have essentially two parts. One is I give you a risk tolerance, and you calculate the VAR. That's the simplest one. You just plug numbers, 3 numbers into a formula, and you got it. Very straightforward. The other one is I give you some target and ask you what's the probability of that happening if you're losing that much. So your uncle says, I don't want to lose more than 20%. I got this investment. You say, well, you got an 8% chance of that happening. So I don't want to, that's too much risk. So we'll talk through them. Let's look at the normal curve. So the way I've always have seen it, you start right on the mean. What's the probability you'll get the mean or less? Any guesses on that? Maybe about 50%, maybe. Does that make sense? If you're right at the mean, what's the chance you'll be lower than that? 50%. What's the chance to be higher than that? 50%. And then we'll go up by 0.01. And then when we get to 0.9, go up by 0.1. And how far out do we need to go? 12, that's probably enough, isn't it? Bill Gates is going to say, what's the probability of 12? So y'all seen the normal curve, haven't you, in some of your classes, right? So clear it up a little bit. So we talked about 2.33, 2.33, 99.01, or about a 1% event. So the normal curve gives you, you're one side or the other. We're focused on the downside. So when I say my risk tolerance is 1%, I'm looking for things that are 1 minus what's in here, which is what you have to do in the exam. I do think Goldman Sachs, they state theirs as what? They say their risk tolerance is 95%, right? So they're actually using what's in this table. So they're doing the 1.64, somewhere between there and there. I remember I had a professor, he required us, we had to interpolate this table. And I would, go out 20 decimal places. And I've since thought, we're starting like this, but then we're going to go out several decimal places. Like, wow, we're a little over precise on this. So it's like, I don't really care. You can use 1.64, 1.65. I don't really care. It's, if anything, I just go to the higher number because I know we tend to understate these anyway. And then you get to the point where you can't even measure it anymore, at least out 4 decimal places. And then once you get way out here, it's a sure thing it's going to happen, or it's an impossible thing on the other side. It's not going to happen. All right, so we're going to use the normal curve. You can use the norms dis function to get that probability. So let's look at a few problems and just see. So you have an Uncle Todd. He wants to buy US large cap stocks, so large companies. He inherited some money. He says, and what's the probability of this? He says he has a risk tolerance of 1%. When's the last time your uncle said that to you? Oh yeah, just by the way, my risk tolerance is 1%. Just wanted you to know that. He does not want to lose more than 20%. So there's this risk tolerance. Can he put all of his money in the US stock market if you have an expected return of 8% and a expected standard deviation of 15%? So his risk tolerance is 1%. So he's doing a 2.33 event, 2.33 standard deviations. So his value at risk, and this is the way I like to write it. I like to write VAR, and I always like the risk tolerance to be in my VAR, so I know what that is. I just think that's really important. VAR 1%, and that's how you write VAR for some reason. Capital A, capital V, small a, big R. And I'm pretty sure 100% of your banks have value at risk in there. Some of them have entire tables that you're talking about. So my mean is 8%. Minus my risk tolerance converted into number of standard deviations, 2.33 times my standard deviation. That gives me a VAR of 26.95%. So what does that mean? 1% of the time, he can expect to lose 26.95% or more. And that or more is really important. How often does he expect to lose 26.95% exactly? Probably never, right? So it's 26.95% or more. And you notice I put it as a positive number just because we just know VAR is going to be. I mean, at USA's VAR might be $3 billion. That doesn't mean their worst cases they make $3 billion. It's a loss. The worst cases they could lose $3 billion to hurricanes or earthquakes. So you just state it as a positive number. And I think your banks are like that as well, aren't they? And your VAR tables, it's a positive number. You just know it's a loss. So it's just the nature of it. So he can't invest 100% in the stock market because at his risk tolerance and with his risk budget, he can only afford 20%, but he would actually lose 26.95%. 1 out of 100 years. Right? 1 out of 100 years. Does that seem right? 1 out of 100 years, you lose 26% or more, or does that seem too tame? I guess it has you measure it because in 2020, you lost 26%, but not for the year, just for a few months, and then it came back. So he might say, well, that's okay. At least I ended up better at the end. So it kind of depends. You know, how many years have we had negative 26? We could go back and see. So he can't invest in that. So he needs to add something to it, add some bonds or something to bring that risk level down. That's also going to reduce his expected return. All right, y'all got it? Y'all see how that works? That's an example of the first one. I give you the risk tolerance. You just got to make sure the budgets is within or without budget. Your boss is interested in a new portfolio strategy. You run your analysis in terms that it has an expected standard deviation of 8% and an expected return of 6%. Your boss has a risk budget of 15,000 or 15 million, whatever, I guess 15,000. So sometimes I give you risk budgets in percents, and sometimes I give them in dollars. So you got to be able to flip back and forth. I don't care which way which direction you go. If I, give it in dollar, you convert it in percents, or I give it in percents, you convert it to dollars, just as long as you're consistent. So the risk budget is $15,000. The risk tolerance is 1.3%. The standard deviation, number of standard deviations, again, it's a 1%. Oh, it's a 1.3. So how do we get 1.3? What are we going to look for in the table? +1 minus 0.013. So we're looking for 98.7 or 0.987. Where's 0.987? Right there. Y'all agree? Close enough, 0.987. 2.23. 2.23, this is one of the most serious problems with normal curve. What was the 1% event? 2.33. This is the 1.3, 30% more likely, and it's 2.23. When you get out in the tails, it doesn't move. Little moves have big impacts. So it's kind of amazing. Your VAR in dollars is, so your VAR in percent is 6%, the expected return, minus 2.23, that equates to 1.3% probability, times your standard deviation, 8%. That means your VAR is 11.84%. Is that within the budget of 15,000? Well, let's convert it to dollars. So $225,000 times our VAR. We're expected to lose 26,640. 1.3% of the time, lose that amount or more. And again, the strategy is too risky. So that again is an example of the first one, but can we do the second one? So we asked the question, how far is $15,000 loss from the mean when standard deviation is 18,000? So the mean is 13,500. How did I get that? 225,000 times 6% expected return. So on average, I expect to make, where did you go? On average, I expect to make 13,500. Our standard deviation is 18,000, not 225 times 0.0. So we take our mean minus that budget. So what we're saying is I expect to make 13,500. I don't want to lose more than 15,000. So we're talking about a $28,500 loss. 28,000 divided by 18,000 standard deviation. That's a 1.58 standard deviation event. So here you've got 26,000. So if you do 26,000 plus your mean, you're talking about, that's like a 39, almost $40,000 difference. Your budget only allows for like a $28,000 difference. So that's 1.58 standard deviations. What's the probability of that? 1.58. That's about 5.71% chance. What was his risk tolerance? 1.3%. So, you're looking at for this portfolio, it's just, they'd either have to really reduce your risk tolerance. I mean, you're not going to go from 1.3% risk tolerance to 5.7% risk tolerance. I mean, it's just going to be kind of ridiculous. So this portfolio is way too risky for them, but at least this portfolio has a 5.7% chance of hitting your risk tolerance. You only want a 1.3% chance, so you can't do this portfolio. You could have converted the entire thing into percents as well, so you have to either way is fine with me, however you want to do it. Your boss has a currency portfolio with a daily risk budget. So daily risk budget. What would you think the expected return on a daily basis for any portfolio? What's the average daily return of the S&P 500? What would be your best guess for the S&P 500 tomorrow? Anybody want to guess? Daily. 5% times 200 days, that'd be like, maybe a really amazingly high return, right? It'd be like 10,000% or something, right? 1,000%. So if the S&P makes 8 to 10% a year, what would you expect it to make on an average day? I'd say 0, right? Wouldn't 0 be your best guess for tomorrow? So when you see these daily ones, our expected return is 0. It makes the math a lot easier now, because now all we do is just take the number of standard deviations times the risk, times the standard deviation. We've got our answer. So I don't know any portfolio where you wouldn't just use 0 for your daily. It just no portfolio, unless you're making 80,000% a year or something. It's just that your best guess for the stock market tomorrow is 0%. Your best guess for Bitcoin tomorrow is 0%. For GameStop, your best guess tomorrow is 0%. That's just because it's on a daily basis. And so what are your banks doing? They're doing daily, right? So on any daily basis, they're their best guess is they'll break even. So they have a budget of 20,000. You want to start a trading strategy that has an expected return of 0 because it's daily and a standard deviation of 2%. Based on a trailing 60-day analysis. Your banks do that as well, right? I was looking at, Joseph, what was your bank? I forget. JP Morgan. Yeah, I mean, he shows the VAR, and then March of 2020, suddenly the VAR gets much larger. Why? Because they got more recent data. It's, it's very rearview mirror kind of focus. So your risk tolerance is 5%. So your risk budget is $20,000. Your risk tolerance is 5%. Your standard deviation is 2%, or if you want to convert it into dollars, it's $10,000. Number of standard deviations 165, 164. So your VAR is going to be 0 minus 1.65 times 2%, or 3.33%, 3.3%. $500,000 times 3.3% is 16,500. Our risk budget was 20,000. Does this look acceptable? They could handle this, right? It's within their risk budget. They're willing to lose $20,000 5% of the time on any day throughout the year. This portfolio would expect to lose $16,000 or more about 5% of the time. So it would be within their budget. They could do this. So 5% of the time, we expect to lose 16,500 or more. Our budget allows us to lose 20,000. So we could actually leverage this up. It's an amazing thing to me. I remember Deutsche Bank came to me. We wanted to put a hedge fund in our pension plan. It's kind of smoke and mirrors because when we immunized our pension plan, our expected return on the assets came down. And that was a little bit of a problem because it was going to cause some accounting issues. So I said, well, what if we just add a hedge fund in there that props that expected return back up? I mean, it's kind of smoke and mirrors. And so they had a fund that was a 1% expected return and a 1% standard deviation. You could just throw that on top of a portfolio. And so what I said is, you know, what I'd like to do is I'd like to put 5% of our portfolio in that hedge fund, but I need to add 1% to my expected returns. So instead of 1% expected return and 1% risk, why don't you give me a 20% expected return with 20% risk? And then if I put 5% of my money in there, I get a 1% extra return. And I could add that to my expected return and the auditors would buy it. And so what did they do? They just turned up the leverage and they gave me a 20/20 fund. I mean, it's pretty amazing, isn't it? They took a 1-in-1 fund and I made it a 20/20 fund. I thought it was great. And they put it in a commingled account thinking, you know, we're going to be the only ones ever investing this. And just a few months later, they called and said, hey, someone else wants to get into that fund. Are you okay with it? Like, yeah, sure, I guess. I'm kind of curious what they're doing too. So it helped. Usually when you do that, the first year is like their worst year ever, right? You hire someone new. Most of my experiences like that. They're one of the exceptions. They had like their best year ever. I was like, whew. I didn't think I could get it approved because we'd never done hedge funds before. I go talk to the CEO who hated everything. And I caught him on a good day, bad day. He's like, yeah, I don't care, whatever. And I said, okay, good. He said yes, right? We went back and did it. So I don't know. He hardly even listened to us. It was a really unusual day. But that helped a lot. And so when I say you can leverage it up, you really can. Hedge funds are really good at say what they look at it, return versus risk. So, hey, this is a 5% fund, 5% expected return, 5% risk. Oh, I want 10 and 10. Okay, well, just double leverage it up. And here's your 10/10 fund. So it's a pretty amazing. So we could actually leverage this up. We could go to the trader and say, hey, let's increase our return. Now this is 0%, but on an annual basis, it's going to be more than that. Let's leverage this up a little bit and get a little bit more expected return because we can afford more risk. All right. So you are a risk manager for AIG. They have a risk tolerance of 0.5%. The credit default swap department has a daily budget of 100 million. They are trading CDS portfolio that has a notional of 4 billion. So what do you do with notional? You handle notional as if it's an actual portfolio, right? It doesn't change anything. If I tell you they have a $4 billion portfolio, or I tell you they have a notional 4 billion, you do the exact same thing. Nothing changes. On exam 2, you'll see I switch between an actual portfolio and a notional amount, but the notional tells you how much risk you're going to have, because even though you might not have $4 billion in actual money, your gain and losses is going to look like you had a $4 billion investment. So you use the 4 billion, expect return of 0. There's daily standard deviation is 3%. Mr. Greenberg's not there anymore. I don't know if he's still alive or not. I should check. So your risk budget's 100 million. Your risk tolerance is 0.5. Your number of standard deviations at 0.5 is 2.58. So we cut our risk tolerance from 1% to 0.5, cut it in half. and we only went from 2.33 to 2.58. So and again, when you have this dramatic reduction in risk, but it doesn't have that big of an impact on the dollars. So someone goes, hey, let's go 0.1% risk. It sounds really, really conservative, but it hardly moves the numbers. So it's kind of strange. When you get out in the tail, you can have a huge impact on your numbers and it doesn't impact your actual calculations all that much. So evaluate risk is 0 minus 2.58 times your standard deviation, or 7.74%. That times the notional amount is 310 million. Your risk budget's 100 million. So what do? At AIG, the traders go and complain to the CEO, and you do it anyway. That's kind of what happened at AIG, right? Except for Greenberg wasn't there. If you talk to Tui, I think he'll tell you AIG probably would not have had its problems if Greenberg had still been there, because he was such a micromanager on risk. But once he left, it got a little more sloppy. All right. So these are the problems couple problems we're going to do on the exam. I'm going to put out on Blackboard just a whole lot of practice ones, so you can go through and get practice on and just make sure you're comfortable. Most students have no trouble with most of them. I usually put one squirrely one out there just to make sure you can do a little critical thinking. So it's usually like 90% of the class gets 5 of the questions right, and then 2% of the class gets the last one right. So we'll see. Maybe this class looks smarter than my previous classes, so maybe it'll be a little higher. I went through this pretty quickly because you should have already been doing this in other classes. I don't know how many times y'all have seen this, but value risk is pretty common. So someone was asking, what does this mean with our banks? Have any of them come out with a 2021 yet? Probably still too early, right? Do you remember what page that was on, Joseph? Their value at risk.
Oh, yeah, so market risk,
Page 70s.
oh, right. I know it's under the market risk section.
They had a firm-wide risk, didn't they?
Yeah, that's the intro.
Oops. So we should be able to find it. Oh, there's only 60 wide.
Just do the acronyms.
Yeah, I think the VIR might actually, it says page 85, but it's not page 85 because firm-wide risk management. There's 2 of them. So there we go. Firm-wide risk management. Yeah, I mean, to me, it's interesting, your universal risk. They have the same thing USAA had with capital risk. It just seems strange to me that would be a risk. Usually capital doesn't attack you. Joseph was talking about country risk. When there's someone here is like, what does it include? What does it not include? So I would think country risk be very specific to political risk in a country, not necessarily the whole global stock market crashes and every country comes down. That would be something else. That'd be part of the market risk. But country risk is very, very specific to what's going on. I do like that they do have estimations and model risk. I think model risk, we're going to talk about model risk. I'm glad they say that, whether they do anything with it. All right, so let's find some tables here. Here's the capital risk. If you're interviewing with a bank, you make sure, if on the operation side for the bank, if you're interviewing on the operation side, look at the Basel Accords and read that on Wikipedia. Be familiar with, capital standards are really, really, really important to banks. So you want to know what's going on. All right, so there's a lot on capital risk. I mean, it's like a huge part of theirs. So let's try the VR. There's just too many of them. That's the problem with it. Oh, var space.
183.
Page 183.
Yeah.
All right, there we go. Well, this page Joseph was showing me. This is a great page. That's their actual VAR calculation. And then COVID hit. Did their VAR actually increase? No, their assumptions that they put in their VAR increased. And why did they increase? Because the market got a lot riskier. So does that, some of this is, this question, is this the right way to measure risk? An actuary would never do it like this. Using just recent history and say, hey, that's going to give us that risk. Because that means if you have a period of time of stability, your calculation of risk is real low. When you have a volatile period of time, that calculated risk is really high. When should you be more risky, after a really mild period or after a really rocky period? I'm much more nervous after years of ease. Why? Because markets get real expensive, the Minsky moment kind of thing. So it seems to be the opposite. But I think they're a 5% risk tolerance, if I remember right. That looks like a lot more than 5% of the time, doesn't it? Even down here, this looks like a lot more than 5% of the time. Now, after COVID hit, they never exceeded their VAR. But that's pretty shocking. So, think through this. This is how they're managing risk. This is we'll lose this much or more 5% of the time. Oh, wait, let's come down here. Does it really make sense? At the end, you're going to assess your banks. Is this bank less risky because they're doing this? Really ask that question and see what's going on. If you saw the previous year, 2019, I think you're going to see that all looked like this. A really low VAR, and that they never exceed even 5% of the time. So, it's kind of interesting to me. So we can find the actual VAR. So here's their actual VAR calculation. Again, it's a positive number. So their VAR okay, so they say 95% confidence, so they're a 5%. I do it the opposite because I'm from the insurance world. So I say their risk tolerance is 5%. So a 1.64. So their fixed income, 5% of the time they expect on a daily basis to lose $95 million because of interest rates. 10 million foreign exchange, 24 million equities, 28 million. And then the diversification effect, that's what we're going to talk about when we use that formula, diversification effect, that all of these things don't happen together. And because of that, a third or more of the risk just completely disappears. So here's the question, we're going to talk about this. Is there a scenario where this stuff actually is highly correlated, just all of a sudden? Doug Hubbard's going to talk about that. Is there a scenario out there where suddenly all this stuff that you thought was uncorrelated, just suddenly everything moves together? Probably March 2020, when you think March 2020 would be one of those freak kind of days. So banks use these VAR back risks. So as you're assessing your bank, think through it. You're the CEO of this bank. Do you sleep better because they're doing this? Is this a good way to manage risk? I'm not saying yes or no. I just want you to question through what they're doing. So it looks like I'm giving you these simple problems, but banks are doing stuff very, very similar to this. They're doing historical VAR, and we're doing parametric VAR, but historical VAR, the advantage of parametric VAR is that if you have a really stable period of time, you don't have to reduce your assumptions. You can keep them higher. With historical VAR, you have a really kind of non-volatile period of time. Your VAR will go lower because that's the way you're calculating it. So I don't like that part of it. We use these calculations at UTSA. So at UTSA, just to tell you specifically, the actuary did stochastic VAR. So they ran simulations of hurricanes and earthquakes. But our CEO, his argument was, well, if we have a 1 in 500 year hurricane, we've never seen that ever before. Katrina was not a 1 in 500 year hurricane. Harvey, any of y'all from Houston? Harvey was not a 1 in 500 year. It was much more frequent than that. So we're talking something like Harvey and Katrina get together and both come in at the same time kind of thing, you know, just massive. His argument, if that happens, that's probably going to have a pretty negative impact on markets. And so I used parametric VAR, and I added like a 1 in 10 year market event on top of that catastrophe so that we have something there. So what were we assuming? You know, normally you think hurricanes and markets are uncorrelated, but our argument, an event that massive is probably going to impact markets. So something we assume is uncorrelated suddenly becomes correlated. Why? Because we're so far out on the tail. So you think about the Tokyo earthquake. Did the Tokyo earthquake have an impact on world markets? Yeah, quite a bit. The market dropped probably about 10% or more. We don't normally think of earthquakes and stock markets being correlated, but that one, it certainly had an impact. So at extreme events, things become correlated. So we decided, let's just add on some market risk on top of this. How much? Well, 1 in 10 years. You know, what else? You know, you're making numbers up at that point. All right, so I'll give you some of those problems, but the more interesting thing is what happens when you have more than one thing to look at, and we bring in correlation. So do y'all know this formula? Does this look familiar to any of y'all? You've seen it, Courtney? Anybody? Anyone want to admit they've never seen this formula before? All right, so there's a few formulas when you graduate with finance or actuarial science or management science. This is one of the formulas everybody knows. All right, so if you somehow miss this formula, extremely important formula. We've got a couple minutes here, so let's try this. So you can see it there. You're going to be doing this on your project. I've already built it for you, so you don't really have to deal with it. I'll show you how I built it in the actual project itself. But let's do some returns. So our expected return on bonds, what would y'all say for today? Corporate bonds, investment grade corporate bonds. 8%, 5%, 3%, 1%, 7%. And go buy some corporate bonds today. What would you assume? Some of you are in John's class. What are current corporate bond yields? Was 6% too high or too low? Too high. Is 2% too high or too low? Too low. So somewhere between there. Why don't we do 3.5? Expected risk. Let's try 4. Stocks, maybe 8. And the historical standard deviation for stocks, if you don't go back to the Great Depression, is about 15%. If you add the Great Depression, it can get a little bit higher than that, but 15%. Here's our allocation, the bonds, the stocks. We put 100%. And bonds, how much do we have in stocks? We have 90% in bonds. We have 10% in stocks. So there's our allocation. Okay. Our expected return is so easy. What's the expected return on this portfolio? It's just so easy. You take the bond allocation times the expected return on bonds plus the stock allocation. The expected return on stocks. Piece of cake, right? That we can do in our sleep. So all the way up 3.5. What's our expected risk? So can I say 100% times 4 plus 0% times 15? Can I do that as my expected risk? And I can in one scenario. What is that one scenario? As long as stocks and bonds are what? Perfectly positively correlated. Are stocks and bonds positively correlated, uncorrelated, or negatively correlated? We're going to say the answer to that is yes. Yes, they are. So we're going to talk about that. But why do we generally think about them? It's uncorrelated, low correlation. Today it worked, didn't it? Treasuries rallied today. Stock market sold off today pretty dramatically. There has been a negative correlation. We're going to talk about when are stocks and bonds positively correlated and when are they negatively correlated. But recently they've been, well, it's hard to say recent because of the inflation link. So that's the expected risk if correlation is 1. What if correlation is 0? So that's when you need this massive formula, and it's a pretty easy formula, right? Because it's, you know, it's just go in order. So we're going to square the weights times the standard deviation squared. Then we're going to do 2 times the weight times the standard deviation times the weight times standard deviation times the correlation. We're going to take the square root of that. So we go in and we get the weight times the weight times the standard deviation times the standard deviation, right? Plus the weight times the weight. I'm squaring the weights, but I'm doing it twice times the standard deviation times the standard deviation. Y'all remember the rest? 2 times the weight times the weight times the standard deviation times 0. That was all a waste because it's times 0. Take the square root of that. If I did it right, I better get what? 100% in bonds. What should my standard deviation be? If I did it right, I better get 4%. Let's see. All right, so that makes sense. And what's my risk over here? The end should be 8%. I mean 15%. What do you notice about the risk in the middle? It's quite a bit lower when the standard deviation, when this correlation is 0. Pretty significant drop in risk. What if correlation is -1? The tails are the same. You all see the reduction in risk there? And there is some point somewhere in here where the risk is exactly 0. When you have 2 things that are negatively correlated, there's some allocation when you can completely, totally eliminate the risk. So what does your finance class say? If risk is 0, what's your expected return? Don't say 0, but if your risk is 0, your expected return is, go back to 3013. Something is risk-free, what's its expected return? The risk-free rate, right? So if you have 0 risk, do y'all think there's a place you can allocate between stocks and bonds so you have 0 expected return? Does that make sense? Probably not, but that's the way it looks. We can actually graph this. You start with risk and then do returns. So let's do the 0 solution. And if I graph that, what is it going to look like? Any guesses? The initials are EF. What does that look like to you? Does that look familiar? What is that? The efficient frontier? You remember that? We're going to be building efficient frontiers in here. There's the efficient frontier. There's 100% in bonds. There's 100% in stocks. Would a financial planner ever recommend 100% in bonds? Says no way, because you can. There's a portfolio right up here has the exact same risk with higher return. Why would you ever do 100%? Would someone recommend 100% in stocks? Well, yeah, I mean, that makes sense. It's on the efficient frontier. It's not like there's a point up here. So there's a good old efficient frontier. What gives it that shape? Why is it? So if I'd done the 1%, I mean, the one correlation, we would have just had a straight line, right? Where would that straight line have gone? Well, it would have gone from 4% up to 16. So on every point along the way, what does correlation do? It gives you a higher return at the existing level of risk. So you can see what correlation does. You'll see that the one correlation would just been a line just like that, right? This is a straight line. So what is the correlation? Lower correlation just bows it out. And the negative one correlation is going to do what? Well, it's actually going to come way over here. And it will actually, at some point, I didn't set up the assumptions right, but at some point, it's actually going to hit zero risk. And in that case, you would never go below that. You know, there's no reason to have 90 or 100% in bonds. My word, you can put 20% in stocks and your risk falls almost to zero. You might as well do that because you're getting a higher expected return. That makes a lot of sense. So that's the efficient frontier. You're gonna build an efficient frontier on your paper, but I've got all the assumptions built for you. But this is real key in finance. This is a hugely important number for us in finance. And so I want to challenge that a little bit. See how reliable is that? Is this a good way? So the reason I'm giving you the project, so you can do something very traditional risk management. And then as you're doing it, kind of think about what you're doing. Is this the way I would manage my risk? Does this make sense in a very traditional approach? And it's pretty common. I was listening to WOAI, and the mutual fund store used to come on with commercials, and they would talk about how they use modern portfolio theory and these sophisticated advanced models. They're doing exactly this. There's nothing, this is modern portfolio theory. I don't know how modern it is anymore. It's been around for 30, 40 years. Good old Harry Markowitz, right, back from the 1950s. Heavy reliance on this. The math is absolutely right. There's no problem with the math. The problem is, what standard deviation do you use? Do you use historical standard deviations or use the future standard deviation? Which would be better to use? So you use the future standard deviation. Which correlation do you use? Historical correlations or future correlations? Should you use for future? What do we actually use? It's historical. Why don't we use future correlations? Because we don't know what they are, but we assume what? That they're related in some way. Are correlations stable over time? Are standard deviations stable over time? Can you look at the last 50 years of standard deviations and say that's a good assumption for next year? And what did JP Morgan figure out? Well, it worked really well the last 100 days, but then COVID came up and then suddenly that grossly understated our risk. Same thing, right? In 2007, you got a standard deviation. How did it help you in 2008? Completely misstated the risk quite dramatically. So how do we deal with that issue? So this is going to set up some very realistic problems, and I'll show you some. We'll start doing them in the next class. Show you some problems that are real life, but I want you challenging, the assumptions. Where did you get those assumptions? So we'll start there next time. Make sure I have you for attendance if you all came in late.